The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. If you've been following the markets lately, you've seen some eye-popping numbers. Gold is knocking on the door of 30% gains this year. Silver is doing even better, and the U.S. dollar is heading the other way. According to the latest report from Rotbart Co, gold is up a staggering 29% since January, and silver has surged past 33%. But it's not just about safe haven demand. The report points to political pressure on the Federal Reserve, a weakening dollar, and a boom in green tech. So what strategies can you take to get on this golden opportunity? Well, to find out more, I'm joined by Joshua Rotbart, founder and managing partner at Rotbart Co. Joshua, welcome back to the show.
Hi, Hongbin. It's always good to be back. Thank you.
Thank you so much for joining us. Well, Joshua, are we continuously seeing the same drivers of gold and silver for the month of August as well? Anything different that you'd like to highlight?
No, just one thing to mention, actually, if you look at the latest numbers, we're up almost 50% in terms of price appreciation for almost all the precious metals. So even more eye-popping figures than what we would expect. And I'll tell you, I don't think there's much change in terms of the big three key drivers. And I would say, first of all, central banks have been continuously buying gold. And it's not new, it's been going on for years, but we're looking at a very strong year for purchasing gold. Almost 1,000 tons of gold were purchased by central banks only last year, and we expect this trend to be accelerated, especially looking at China, Poland, Turkey, India. It seems like all the central banks are basically buying gold, and that's, of course, increased demand, but also that signals the individual investors, people like us that are considering where to park our money, that gold is the asset where you want to be. And that leads me to the second fact, which is, again, investors hedging against geopolitics. And a lot of questions around, what's going on with the war in Russia, what's going on with the debt in the U.S. Investors are concerned. They are looking at high valuations in the equities market, and they are afraid that a correction in the equities market will happen soon, and gold usually flourishes under these terms. And the last factor to bear in mind is, as you mentioned, again, the dollar is weakening. And it's weakening compared to other baskets of currencies, which means that if you are not buying in a USD-denominated jurisdiction, actually gold propose a very good opportunity. And on top of that, you have continuous de-dollarization, so countries use the dollar less and less. So overall, geopolitics are, in my opinion, what's moving the markets now, from central banks to the individual investors, all the way to weakening dollar.
Well, there have been three key events last month, in the month of August, which was a tariff exemption for gold bars, double tariffs on India, and political pressure on the Federal Reserve. Which of these is having the biggest psychological impact on investors right now, though?
Long term, it's the issues with the Fed, the political pressure on the Federal Reserve. Definitely. You see American president that is lashing out, the executive trying to fire some of them, to change the balance of power, to mold the Federal Reserve in a way that suits the U.S. administration political needs. And for everyone looking at it, it's a big reason for concern. And you are right. I would say the tariffs on India and general tariffs on goods are also an effect to boost gold. I would say more short term. They add another layer of uneasiness in the market, and they add another layer of pricing. So if you want to import goods from India to US, of course, you're going to pay more now. So overall, I would say this creates a short-term pressure on the market. But if you're looking a bit more long-term strategically, what's going to happen with the Fed is a big question mark that kind of hovering over the markets in general.
I see. Well, also, a major player in the physical gold market is China. How are trends in Chinese retail demand and central bank buying influencing these global price moves? And is that demand sustainable?
Look, China has been a very interesting market to look at, because if you look a couple of years back, it seems like young Chinese was kind of staying away from gold. But if you're looking at what's happening now with property prices under pressure, equities are quite volatile. Households have shifted towards small bars, coins, and jewelry as a safe place to park wealth. So if you're looking at the demand for bars and coins in the first half of 2025, it surged up 26% year on year to almost 240 tons. And that's the strongest first half of demand in China since 2013. So the Chinese consumer actually is shifting its focus from other products. It used to be you're going to buy Hermes bags and iPads. Now it's like, we're not going to spend money on this stuff. We're going to buy hard, cold cash that performs well in times like this. That's on the retail side. If you're looking at the central bank, the People's Bank of China has been one of the biggest and most consistent buyers of gold in the world. We're looking at 10 straight months of purchases, 74 million troy ounces at the end of August. So again, staggering numbers, and they are keeping this strategy of diversifying away from U.S. treasuries and reducing reliance on the dollar and its reserve. Add one more thing about China. If you look at what's happening now, if you're following what's happening between China and Hong Kong, the Chinese government is pushing Hong Kong very hard to become the link to the Chinese gold mark. We've seen the Shanghai Gold Exchange opening vaults onshore in Hong Kong. That's a new one. We're seeing the Chinese central bank trying to lure investors, sovereign countries, to come and put their gold either in Hong Kong or China. As I mentioned, generally in central banks, definitely China, both on the retail side and in terms of the government, are definitely pushing and are very bullish on gold.
Right. Well, your strategy section also advises to buy on pullbacks. After such a strong run, what would a healthy pullback look like, though? And what would a sign of a true reversal be?
I would say if you're looking at the pullback of around 5% in the price, that's manageable. I wouldn't say that's a pullback. That's basically allowing the market kind of to catch its breath and to bring new investors back. We're going to see people taking profits. I think if you look at more than 5, maybe 6%, that may be a reversal. But honestly, I'm very bullish. I don't see any, I speak a lot around the world, and everyone's saying there's lack of good news in the market. So I don't think we're going to see a true reversal, but we're going to see maybe correction in the market because, nothing goes up in a straight line all the time.
Right. So what's the biggest potential risk to this, rally? What could happen in the news that would cause investors to suddenly reverse course and sell their gold and silver?
We can look at inflation and the interest rate narrative. I think if we're going to see inflation kind of coming down, especially in the U.S. and Europe, that could trigger a reversal. If we see, good news on the geopolitical stage, that could use, suddenly low inflation and Trump is smooth talking the world, maybe end of the world to Ukraine. So we need to see some dramatic shift in the vibe, in the energy in the market. And again, the equities market are showing high valuations. People are concerned. So, technically everything is good. We're going to see gold going down, but otherwise we just expect a correction rather than a true reversal.
Well, the gold price chart shows it's been volatile, yet it's presented as a stability anchor. How should investors reconcile the short-term price volatility with the long-term stability and hedge narrative that surrounds gold?
Look, I'll tell you, and I can tell you on a personal note, very risk-averse. I don't like when gold moves so quickly and moving up relatively quickly this year. Having said that, again, the fundamentals are very supportive. And there is a reason to believe the price will go up even further. So I would say that when we look at gold, we need to look at it as a sort of an insurance. And you don't measure the value of your insurance policy based on small changes in the monthly premium. You hold it for those moments when stability really matters, when a crisis hits, when currencies weaken, or when policy credibility comes into question. So I would say adding gold to the portfolio, although it's more, I wouldn't say volatile, but it's the pace of appreciation is quite high, still stabilizes the volatility of the entire portfolio. So look at gold as a stabilizing component in a portfolio. Don't look at it as a standalone trade.
Right. Well, looking at the year-to-date leaderboard, if an investor's portfolio is solely made up of, the S&P 500 and U.S. bonds, it'd be significantly underperforming a portfolio with metal exposure. So does this performance gap signal a necessary permanent shift in strategic asset allocation, or is this a tactical opportunity within a longer-term cycle?
So again, I can tell you, I travel all around the world talking with investors, people invest in gold and other assets. And one thing I realized in the last couple of years, the appetite for gold in one's portfolio is increasing. So we're not giving up the equity bond allocation, but what we are seeing is the allocation for gold actually increases. When I started working in this industry 15 years ago, people would hold 1 to 3% of their portfolio in gold. Now they're talking about 3, 5, 10, and even beyond in terms of the total allocation to one's portfolio because they're seeing the upside, they are seeing the cycles, and they understand what the governments are understanding. Gold is the alternative to the US dollar. It's the hard currency that we need to keep in our pockets, in our portfolio. So, again, I think the outperformance of the metals shows a tactical, of course, opportunity, but it does allow investors feeling more comfortable in allocating more of their portfolio to precious metal on the expense of bonds and equities.
So for someone who hasn't bought any gold or silver yet and is worried they've missed the boat, what's your one piece of advice, Joshua?
You don't miss the boat when it comes to gold. You know, I met a client now, and they were very sorry they didn't buy the gold last year, 12 months ago. And I told them, buy today because you'll have the same regret feelings next year. At the end of the day, it's not a one-time trade. It's a foundation of a portfolio. It's like an insurance. Gold will appreciate in value. Gold appreciates in value on average of almost 12% per annum the longer you hold it. So don't be afraid of the pricing. Think medium to long term. You will not regret it.
All right. Well, thank you so much, Joshua, for joining us today.
Thank you so much, Hongbin.
Thank you. That was Joshua Rotbart, founder and managing partner at Rotbart Co. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.